Hello, everybody. Welcome to this webinar brought to you by Bursa Malaysia that is titled From Global to Vietnam. My name is Shen Chu. I'm the moderator for this session. Now, Vietnam is definitely one of the growth engines in ASEAN. And last year in 2022, Vietnam delivered a fascinating GDP growth of 8%, which outperforms many of the emerging countries. And with the ongoing US-China tension, it has further escalated the need for China plus one, in which Vietnam is one of the key beneficiaries. So today, we're going to look into the global macroeconomy, and then we'll zoom into Vietnam and what are the investment merits in Vietnam. Before we begin, disclaimer, whatever we share in this session is only for educational purpose. In no way that we give any recommendation for you to buy or sell any listed securities that we mentioned here. If you decide to make any investment decision, you're 100% responsible for all your investment risk. Now, today we are very honored to invite the Vice President of Intermediary Distribution from UOB Asset Management, Berhad, to join us in this session. He's none other than Mr. Gabriel Fong. So allow me to briefly introduce Mr. Gabriel. Mr. Gabriel Fong joined as a Vice President of Intermediary Distribution of UOB Asset Management in May 2019 and was responsible for key account business development functions inclusive of commercial and private banks. Prior to joining the UOB AM, Gabriel was attached with one of the largest local asset management firms where he had worked closely with various financial agencies under his account to drive sales and achieve numerous agency awards. Gabriel started his early career with 4 years of experience in banking sales and subsequently shifted his career focus towards fund management business and sales management role. He has 10 years of experience in the fund management business. So it's a pleasure to have you here in this session, Gabriel. How are you today?
Hello, everyone. Hi, Shen. I'm great.
Yes, cool. So I will stop sharing my screen while you can take over.
Okay. Give me a moment. Just checking if you are able to see what I have shared.
Yes, perfect.
Okay. Thanks, Shen, for the introductions. Indeed, a very pleasure to meet everyone here. And thanks to some Malaysians for having me today. So what I'm going to share with you, like what Shen has mentioned, from global to Vietnam, right? And thanks everyone for joining us this evening. I think 8:30 to 9:30 is definitely a very, very precious time in the evening that you guys going to have your family time, you guys going to have your dinner, but you choose to stay with us tonight. So without further ado, let me share what is our view towards the macro environment moving into 2024, right? So since we are towards the end of 2023, what are we expecting towards 2024 as a firm of UOB Asset Management? So comparing both year 2023 and 2024, we think that it feels like a deja vu, like what my title has mentioned. But 2024 should be a more comfortable year for investors, so to say. So let's just compare both years, what we feel 2024 might be experiencing as investors and as compared to what are the key debates for 2023. So looking at 2023, early of the year, I think if you could recall, many of us are talking about recessions, be it a soft landing, be it a hard landing, but we are talking about a very high probability of recession happening in 2023. But if we could fast forward to 2024, what we are seeing here right now, we are no longer, or we tune down the probability of recessions, but we are shifting towards softer tones of soft landing or no landing at all. No landing meaning the economy continue on expansion basis as a led cycle of economy cycle, and we might avoid recessions in 2024. So a very key hot topic in 2023 this year is inflations. So we are thinking whether inflation is going to come down. We are doubting that inflations will come down without a recession. Then we think Fed might engineer a hard landing or recessions before everything reset to normal. But moving onwards to 2024, we will start to talk about how much inflation will come down rather than whether the inflation will come down, right? So if you could recall back this year again, we are talking about how many times of interest rate hike, how steep, what are the frequency of interest rate hike. But towards next year, we are talking about how much of interest rate cuts in 2024. So if you look at it, the key items of debates are still similar: inflation, interest rates, recessions. But moving into 2024, the tone has become a more comfortable tone rather than 2023, a more tougher tone, so to say. Right, so 2023, we are debating on the probability of recessions, and 2024, we might debating on how strong the corporate earnings will go in 2024, right? So these are some of the recaps that we think is good to bring out to all of our investors today, because it clearly distinguish a different playground for 2023 and moving onwards to 2024. So I summarize 5 key importance view and investment implications here, just in case many of you might be tired of working today, you fall asleep during my presentations or tonight. So at least you caught the 5 very key important points in the early sessions of my presentations. So first, the hiking cycle is definitely done. We are towards 90 to 95% of the hiking cycle. At most, we are expecting 1 more hikes before the rate cuts coming into the picture second half of the year. So the key message here is that the hard part is really already done, and we are looking towards a more comfortable year in 2024, because like what I have presented to you just now in my first slides, inflations, rate hikes, recessions probability, the uncertainty in growth, these are all has been de-risked over 2023, and it will be a better position in 2024. So what we see here right now, which a little bit controversial against most of the consensus, is that we don't see a recession in 2024. Some of the analysts on the streets or the consensus, there is a probability of recessions, but we see that as a very, very low probability of recession in 2024, because if you look at it right now, the economic momentum simply doesn't show that the recessions will come in the next 12 months. The market cycle currently is positioned as a late cycle. Definitely, there is a mixture of view in late cycle, but historically, if you look at late cycle, asset classes tends to perform well all the way until the recession hits. So what we see here is that the market will be having a better breath. This year, the market is definitely supported by service sector, and moving onwards to next year, the manufacturing part of the economy should take over as a growth engines, right? So we are expecting 2024 in general should be a more comfortable year, at least for 2 major asset classes like stocks and also bonds, right? Stocks, we are looking at high single digit of growth that will drive the share price. And secondly, if you look at bonds, which is the fixed income, it should be driven by locking in the high yield, and also coming into the rate cuts, you should have some of the price appreciations, right? So these are the 5 major key views that we would like you to take off in these evenings of webinar. So let's just take a step back and try to see what is the overall investment cycle that we are belongs to right now. So as a start, let's start off with the recessions in COVID era. So so-called the COVID era. It sounds like very it sounds like happened many years ago, but in fact it is just 3 years back. So COVID era, if you look at it, we have a very steep and sharp recession in a very short period of time. That is happened in 2020, if you guys could recall. Then during that time, Fed and most of the central banks in the world cut interest rate in a very strong manner, pumping the liquidity. That is where, in a very short time, the economy rebound back in 2021. So in 2021, coupled out with reopens of economy post-lockdown everywhere, so you can see that the economy actually shoots up very aggressively, and it turns to be overheated. So when overheated, inflation starts to kick in, and most of the central banks in the world, they wanted to control the inflations. That is where rate hikes starts to get into the picture in 2022. So that marks the peak of the cycle of expansion, and slowly it comes down. So up until 2023, we are somewhere around here. A lot of people are debating whether are we going into a recessions, or are we going into a no-landing, whereby we continue our last stage of cycle, the last stage of economy cycle. So what we think here, we think when we are belongs to here, in the middle here, we are heading towards a last cycle of economy expansions towards 2024, before the recession starts to kick in somewhere around 2025 or later. I will show you why we think so. First, of course, if you look at the GDP growth, especially on the real GDP, exclude inflations. So looking at the number, 2023, we have most of the regions around the world in a positive manner for real GDP growth. And fast forward to 2024 on the forecast, you will see it is also a positive numbers for all of the regions. So the numbers might be slowing, but it is still positive. If you are talking about a recessionary environment, it should be looking at the negative regions, similar like the COVID recessions in 2020. So if you are comparing the number, say for example, on a global landscape, 2023, 2.8%, 2024, 2.6%. If you compare back, it is somehow similar to what is happening in 2019 at a 2.8%, which is the last cycle of economy expansions. So what we think here, definitely on the GDP level, we are on the last cycle. And if you are talking about recessions, which move towards my second point, when we talk about recessions, definitely people lost their jobs because most of the corporate companies are cutting employment. But right now, if you look at the number on the table on your right, since October 2023, we don't see any non-farm payroll fall below 50,000. So if you are talking about a recession, and you are talking, if you are having past recession as an example, be it 2020, 2007 subprime crisis, 2001 dot-com bubble crisis, most of the recessions 6 to 12 months prior to the recessions, there is definitely the unemployment rate is going to shoot up. But right now, we don't experience such kind of recession, such kind of situations. And if you look at it, even the employment has started to ease off a little bit, but corporates companies around US is still searching for workers in order to maintain their minimum conditions for their companies to work around in the normal circumstances. So employments, we don't see is going to be the labor market is we don't see is going to be in a very bad conditions. So that is where we don't see it will brings towards a very recessionary environment. So next, this is the goods spending and the service spending, manufacturing PMI and also service PMI. So if you look at US particularly, the line in orange and also the line in blue, you can see in the COVID recessions, goods spending, service spendings drops down very sharply because people cannot spend their money. People are locked down inside their home. So what is happening post-COVID? If you look at the line here, the goods spending is the one that spike up very fast. This is where when we lock down, we tend to do online shopping. We go to Amazon, we go to Facebook Live, we go to Lazada, Shopee to buy goods online. So that is the era whereby we lock down and we cannot spend our money and we buy things online. Goods spending has spiked up, but we lock down, we cannot go to salon, we cannot go to restaurant to dine in. Service spending is down. But moving towards 2021, when reopen starts to take place, people goes out and spend their money in saloon, spend their money in cinema, restaurant, dine-in. That is where service sectors speed up, while the goods spending has come down because of all the supply chain issue. The factory has to go back to normal conditions. The cargo is jammed, and that is where the goods spending is down. So moving towards 2024, what we think and what we see, service sectors starts to normalize because people like you and me, we built up a lot of cash during COVID. But right now, when we spend, the money, our cash reserve starts to deplete. And that is where we are back to normal right now. But the goods spending starts to increase because in 2022, a lot of inventory in US has started to build up. But in 2023, they start to deplete very fast. So right now, a lot of company has to replenish their inventories, and you can see that the momentum of good spending has started to pick up. And we think 2024 is the year whereby manufacturing engine is going to take over the service engines to support the economy, right? So this is again, if you look at US manufacturing PMI from different regions of US, for example, Philly, Richmond, Kansas City, Dallas, and etc. The line in black represent the average of most of the regions around US. And you can see the manufacturing PMI has actually starts to pick up. And when manufacturing starts to pick up, like what the chart on your left has shown, 2022 is a year where inventory starts to build up very, very fast. 2021, a lot of companies order their goods because they're scared. They're scared they don't have things to sell. And cargoes is jammed. Factories cannot fulfill their orders. So they order, and order. But everything was jammed in the inventory in 2022. Coming into 2023, inventory starts to deplete. And this is where, if you look at Asia, whereby Asia is the regions whereby Asia is the regions where whereby if you look at it, Korea and Taiwan, these two countries are the leading indicators of exporters. They have started to pick up in terms of their exports activities. So another things that I'm going to share to you in terms of business and in terms of housing investments, if you talk about recession is going to hit, definitely business confidence, housing investment is going to slow. But if you look at right now, the chart on your left, the outlook from most of the CEOs and the willingness for them to spend capex, although it's softening, but it is still positive. Similarly, like housing investments, although it's softening, but it's still positive. So that is where, based on manufacturing, based on business housing investments, based on unemployment's outlook, we do not think we are heading towards a recessionary environment, but rather it is a direction towards a less cycle of economy. And right now, the pressure for Fed to continue to hike interest rates is getting lesser and lesser because most of the CPI's numbers is coming down, especially if you look at rent, if you look at core goods and also service sectors, it is coming down. Rents, although is still on the high side, but this is something lagging in terms of the indicator. If you look at the Zillow housing rent index, which is a more forward indicators, actually the rent has come down somewhere around a 2% level, right? So with that, to wrap up, we do not think recession is coming, but rather this brings to the themes of our presentations for tonight, which is a structural themes of higher for longer. So what do we mean by higher for longer? We hear a lot of people talking higher for longer, and it represents a lot of meaning. Some people talking about higher for longer because they think that interest rate will stay higher for longer up until Fed starts to cut interest rate coming towards second half of the year. Some of them are talking higher for longer because they feel that inflation is there to stay higher for a longer period of time. But us in UOB Asset Management, we think for higher for longer simply means that the rates is structurally going to stay for higher moving towards next year. So this is a chart whereby I'm going to share to you different kinds of investment regime. Sorry, different kind of inflation regime. Starting from 70s, 80s era, if you look at the average inflations during that era, it is at an average of 6.5%. It's very, very high. And during that time, the Fed rates it can go all the way up to 20%. So it is a hyperinflation during that era, and this is the era whereby we are trying to avoid. Coming to the 90s and 20s era, the 90s and 2000 era, the inflation stays slightly higher, 2.8% on average. So that is where you can see the line in pink, which is the Fed rates, staying higher as compared to the inflation number. This is with the objective to press down the inflations so that it won't go until the inflation regimes of 70s and 80s era, which is a hyperinflation. But post 2007 global subprime crisis, we are at a disinflationary environment whereby the inflation is struggling to meet the 2% average inflation. The average inflation is 1.8%. That is where you could see the Fed rates is at the all-time low, below the inflations, in order to push up the inflations. But this has failed for the past decades. And right now, what we think the inflationary regimes is going to move forwards is towards the inflationary environments of the 90s and the 2000 era, which is slightly higher inflations, but under a controlled inflation. So the rates is going to stay high for a longer periods, because notwithstanding that the inflation is slightly higher, but because of all the geopolitical tensions, because of the deglobalizations post US and China tensions, because of all the EVs, ESGs kind of efforts in order to drive net carbon neutrality, net zero. A lot of commodities are being put into the pictures. So that is where you could see inflation starts to kick in. So with a slightly higher inflationary regimes, it doesn't really, it is not necessarily bad for the markets, because under a very low interest rate environments, asset classes like equities tends to outperform, but other asset classes is not really performing well. But when it comes to 90s and 2000 era, if you are expecting the interest rate cuts towards second half of the year, most of the market consensus is expecting a 4.5% to 5% of Fed fund rates coming to next year, which is at this era. If you look at the table on your left, 90s and 2000 era, looking at the GDP growth, it is the most robust GDP growth across three inflationary regimes. And if you look at the market breadth for different asset classes, the 90s and 2000 era typically have a healthier performance across different asset classes. So it's not necessarily bad if you are moving towards a slightly higher inflationary environment with slightly higher rates, but the economy tends to run well under these kind of conditions. So higher for longer, if you're looking on Asia Pacific ex Japan per se, under higher interest rate environments, Asia Pac ex Japan's equities, if you look back to past history track records, it tends to perform well against global equities. So this is, of course, definitely if we are referring back to the history. But looking at right now, what is happening in Asia Pac ex Japan's, the largest pie of Asia is China. China is still down with the confidence, be it the corporates and also the consumer confidence. Real estate is still down, but where are the pockets of opportunities in Asia? Southeast Asia definitely is one of the area within Asia that is underappreciated. Southeast Asia's, if you look at the past 5 years performance, of course, if you're comparing with China, China is definitely the growth engines for past 5 years. But Vietnam, Malaysia, India is doing quite well. And moving towards next 5 years, where are the growth engines that is going to come from? You will see Vietnam's will be the growth engines in Southeast Asia for the next 5 years. The nominal GDP growth for Vietnam's next 5 years is going to outperform India, outperform Indonesia, and outperform China. And I will share to you why Vietnam's should be a hidden gems for as a growth engines that you should start to look into. Okay, for case of Vietnam, Why we should look at Vietnam right now? Of course, we talk about we talk about growth, because Vietnam's for the last decades, it has a very high growth, just rightly behind China. But like what I have presented just now, the growth over the next 5 years is going to be tremendous performing. And if you look at it, Vietnam's 2022, which is last year when everyone is down, it is giving a growth of about 8% in terms of GDP. This year, although it's slightly down, and most of the consensus is expecting Vietnam to close the year with 5% of GDP. But moving towards next year, 2024, we are expecting Vietnam to have a GDP growth of 6 to 6.5%, which is a very, very good number. So, of course, this is definitely driven by external and internal factors. External factors, if you look at it, Vietnam's over the past many, many years, it has been driven by a very strong and stable FDI inflow. So the FDI inflow in Vietnam is very applaudable. If you look at it, most of the FDIs, where are the FDIs coming from? Japan, South Korea, and also Singapore. So these are the three major countries whereby they pour a lot of foreign direct investment into Vietnam. So just to take a step back, 2022 is where South Korea has upgraded their relationship with Vietnam into a comprehensive strategic partnerships. This year, Japan and lately US has also upgraded their partnership with Vietnam. This is where we are expecting a lot of FDIs will start to come into Vietnam, especially from US, because right now the FDI from US into Vietnam is just less than 3%. So you saw over the news that Biden is going to put efforts into the investment into Vietnam. And if you look at what Vietnam's right now, they are having a very rich quantity of rare earth. That is the resources required for semiconductors. So China is one of the largest rare earth exporter, followed by Vietnam. And the FDIs that goes into Vietnam right now, we see a lot of technology companies is pouring into their investment into Vietnam. So if you look at year to year, FDI being dispersed into Vietnam, it has a very, very healthy growth, notwithstanding that Vietnam has a very young and hardworking populations. And of course, the political stability in Vietnam is definitely one of the very stable political country in the regions. So, like what I mentioned, the Vietnam has started to evolve itself. 10 years back, 15 years back, if you look at what Vietnam is exporting, they are exporting a lot of agricultures, fisheries products, textile, garments. But right now, in fast forward 10 years to where we are, Vietnam is one of the countries that produce a lot of electrical items, phones, machineries, and etc. as part of the items that they export. We are talking about FDI. So a lot of big tech names has increased their investments. These are some of the examples that of the companies that starts to build their factories, putting into their investment into Vietnam. Foxconn, I think, for example, every one of you know these company names as one of the largest suppliers for Apple. Pegatrons, I think this is something that is less well known, but this is a Taiwanese company's second largest suppliers for Apple as well. Intel, LG, Apple's, these are all big names that start to invest, put their money into Vietnam. And of course, talking about the second growth driver is the trades, import and exports. This is very important because all this while, Vietnam has a very healthy trade surplus. With a healthy trade surplus, this is where they are able to maintain and stabilize their Vietnam dong. They are able to upgrade some of the infrastructures in their countries, keep their economy robust. These are depending on the import-export and trade balance. So far, this year, the trade has been slowing, so to say. The exports has been slowing. This is due to, like what I mentioned, the inventory for last year has been built up in a very high level. Coming to this year, as most of the companies has started to deplete their inventory in a very fast pace. 2024, we are seeing the exports for Vietnam will start to pick up once again. And in fact, October, November is where the months that we started to see exports for Vietnam has started to pick up, because US is one of the major exporters from Vietnam, and the US inventory has started to deplete. Talking about internal growth, Vietnam, needless myself to mention, it is a very, very young population. And when we talk about young populations and people are willing to spend, and a lot of tourists comes into Vietnam to spend their money, you could see a very robust domestic consumptions, right? So this year, and even towards last year, Vietnam have received very, very high tourism arrival into the countries and spend my money. And of course, the middle income classes of Vietnam is getting stronger and stronger. The uprising of the middle income classes of Vietnam is also part of the reason why Vietnam domestic spending starts to increase. So one brand that is hardly penetrates the Vietnam consumers, if you happen to be in Vietnam, you will see one of the coffee brands is very, very hard to penetrate Vietnam. They are domestic consumers. So this is one of the very interesting scenarios happening in Vietnam, because Vietnamese, they like their own coffee, so to say. And us in Malaysia, we always like to drink the international coffee brands that we have, but is hardly able to penetrate Vietnamese markets. The second internal growth driver, of course, when we talk about young populations, people tend to go over the cities to work, and we see a very strong urbanization rates happening in Vietnam, especially on tier 1 and tier 2 cities, apart from Ho Chi Minh and also Hanoi. So this, of course, driven by a lot of employment opportunities in the major cities across Vietnam. Internal growth drivers number 3, that I personally think is very, very important, because if you have a very strong FDI, so to say, but your internal infrastructures, be it seaport, highways, railroads, are still not really complete to support the economy, that is where Vietnamese governments are very willing to pour the money to support all these internal infrastructure spending. If you look at the chart on your left, 2023 is where the government spent $30 billion to build and to support their infrastructure spending, because the government thinks that moving towards few decades, it is very, very important to upgrade their infrastructure to continue to support the growth of Vietnam. Number one, if you happen to fly to Vietnam, most of the time you will land at Tan Son Nhat Airport. So these airports per annum is receiving the capability, the capacities is able to receive 20 to 25 million of visitors. But they are building a new terminal in order to upgrade this airport. Plus, there is another airport that is being built called Long Tan International Airport that are way bigger. And when you landed into the airport, you can directly take the metro rail all the way to Ho Chi Minh cities. So this is something under constructions, airport. Secondly, highway. When we talk about Vietnam, if you look at the Vietnam maps, it is a coastal line from north all the way until south. So when you have a lot of factories in the north or in the south, you will need to transfer your goods manufactured in the factories to the seaports. So the highway is still not really completed. That is where there are, if I'm not mistaken, there are 12 to 13 highways being built from north all the way until south, and this is all under construction. So a lot of infrastructures are still ongoing to be upgraded, and this is where it presents a very, very good opportunities for you to start to look into Vietnam as an investment. And of course, when most of the countries in the world are hiking interest rates, Vietnam is one of the countries that cut interest rate for 4 times this year in order to stabilize their Vietnam dongs. So this is where you could see the State Bank of Vietnam is very, very actively managing their Vietnam dongs currency exchange rate against US dollar in order to stabilize the Vietnam dongs and also to stabilize their capital markets. So as a result, if you could look at the performance of the Vietnam dong against some of the major currencies in Southeast Asia or Asia, Vietnam dongs for the past 5 years, it depreciates, one of the least depreciates currency against US dollar. It is just down by negative 0.9% on annualized basis against US dollar. So it is also one of the stable currency after Sing dollar, after Indonesia rupee. Okay, so this is very important because when you have a lot of FDI coming into Vietnam, the companies are expecting Vietnam dongs to be stabilized against US dollar so that they are not caught in surprise all the way. So we talk about external, we talk about internal factors of Vietnam's, and my last part of the presentations, I'm aware of the time, of course, is the Vietnam stock markets. So the Vietnam stock markets has actually evolved 10, 15 years right now since global financial crisis in 2008. So during 2008, there are only 330 companies listed in the overall Vietnam Stock Exchange, inclusive of Ho Chi Minh and also Hanoi Stock Exchange. So right now, if you look at it, 15 years back, it has grown to 1,005 companies listed in the stock exchange. And the market cap has grown from 15 billion US dollar to right now 247 billion US dollar. So over the course of 15 years since subprime crisis, the Vietnam stock market has actually getting more and more matured. And right now, if you will start to look into the stock markets of Vietnam, it is cheap. The trailing 12 months PE, and of course, the forward PE is one of the cheapest in the region, but with the very strong earnings growth moving forwards. Cheap and good is very, very hard to find right now. Okay. So as a last slide to conclude my presentations, this is against the view of UOB Asset Management. We have the view from our counterparts in Vietnam, UOB Asset Management Vietnam's. What we are forecasting right now on a conservative cash for Vietnam's in 2024 next year, the earnings grow by 7%. On base case, we are expecting Vietnam for next year is growing earning per shares at 12%. So if this materialize without affecting the PE at 15 to 16 times is still on the average, 10 years average. We are expecting 2024 on conservative case that the VN index shall grow at about 10%. On a base case, whereby if we are expecting earnings to grow at 12%, VN index will be growing at 21%. Right? So with that, I will pass back the floor to you, Shen.
Thank you so much, Gabriel, for sharing with us the macroeconomic outlook, as well as your view about a possible US recession. And also zoom in into ASEAN, in particular Vietnam, to tell us about the growth drivers in Vietnam, be it from external factor and also the internal factor. All right. So now that we have gotten a view of the Vietnam economy as well as the stock market, so if any question to ask our speaker today, you may write your question in the Q&A box. Gabriel, just now in your chart, you show that there have been FDIs, growing FDIs into Vietnam. So the first question by Lim is that does US not have any FDI into Vietnam? Because we see that we have FDI from China, Singapore, Japan, Korea, right? How about America?
America, the FDI from US is very, very low. Like what I mentioned, the US FDI into Vietnam is less than 3%, so to say. So what we feel is that moving onwards, especially when if you look at the Biden's visitations to Vietnam's and subsequently upgrades US Vietnam's partnerships to a comprehensive strategy partnerships. So this is expected to bring out more FDIs coming into Vietnam. But right now, it is less than 3% from US into Vietnam.
I see. All right.
Yes.
Thanks, Gabriel. The next question by Annie is that what are the potential risks of challenges that we might face if we want to consider Vietnam as an investment destination despite its strong economic performance?
All right. Vietnam, if you are looking at Vietnam as your total investment portfolio per se, it is a single country. So when we talk about single country, definitely the risk is going to be slightly higher. Notwithstanding that, a single country and a frontier market like Vietnam's, it is subject to the external factors. So for example, if we take a look, 2022, even the Vietnam's GDP is growing at 8%, but the external factors like global economy is slowing down. That is definitely going to take a hit for Vietnam as well. So this is one of the potential risks whereby if you look at it, you wanted to invest into Vietnam's, the global the external risks might be also affecting into Vietnam's. And on another part is that Vietnam's, if you talk about the real estate, the real estate sectors for Vietnam, it is still a problem that is lingering around. The real estate sectors has been slow way back in 2022. Of course, right now it has started to get better, but it is also one of the potential risks when you are investing into Vietnam's.
All right, thank you, Gabriel, for sharing your perspective. Now we learned that from you that the Vietnamese central bank has cut the interest rate since March this year. And despite the interest rate cut, the Vietnamese dong seems to perform fairly well against a hawkish US dollar. Why is that so?
Okay, talking about Vietnamese dong, they the State Bank of Vietnam's, they tends to when your US dollar tends to be staying on the high side, when the US hike interest rates, a lot of flows goes back to US dollar. But this is where the central banks of Vietnam, they have to cut interest rates. They have to pump liquidities into the capital markets in order to stabilize Vietnamese dong. And this is against the objective whereby if they don't do so, it will affect a lot of their foreign investments. And this is one of the key items whereby the central banks wanted to protect. So that is where, if you look at it for the past many years, Vietnamese dongs against US dollar, it will move in a similar directions.
Thank you so much, Gabriel. Now, just now we also learned from you that the E&E part of the Vietnamese export has grown for the past decade. Right now, I think it has about 40% if I see the chart correctly just now. So the question from Raj Kumar is that, do you see a threat from Vietnam towards the semiconductor industry in Malaysia, in particular the back-end processes?
Okay, I would say it's a different ballgame. So if you're looking at the semiconductor industry in Malaysia, is partly focusing on EMS, that is somewhere in Penang. Penang is having a very good ecosystem of semiconductors in Malaysia. So the prominent sectors within semicons will be EMS in Malaysia. But of course, if you look at what is happening in Vietnam right now, it is mainly a divergence of China plus one. So with the US-China tensions that is going around, a lot of companies based in China, they have shifted their manufacturing into Vietnam's. Like what I have shared, Foxconn, Luxshares, Pegatrons, these are most of the prominent players that supply to NVIDIA, that supply to Apple ecosystems based in China, but right now they are shifting to Vietnam. So it's a different ballgame, so to say. I wouldn't say that it is going to affect the semiconductors industry in Malaysia. Number one is because the characteristic of the semicon is different. And number two, definitely the market share is very, very huge. And it is up to the both country to share over, and it might be even plenty of the pie to share.
All right.
All right.
Thanks so much, Gabriel, for sharing your perspective here. The next question is, could you elaborate on how the interest rate cut recently protects the local businesses within Vietnam? Additionally, is the interest rate cut also meant to weaken the Vietnamese dong to boost the export? What do you think?
Okay. The exports of Vietnam is very depending on global economy. US is one of the major exporters of from Vietnam, with 30% of Vietnam exports is going into US. So I would say that the US inventory would affect Vietnam exports, like what is happening this year and last year. 2022 is where the inventory in US has built up tremendously, and that is where the exports from Vietnam has low. But coming to 2023, first half of the year, the US inventory is depleting in a very, very fast pace. That is where moving into Q3 this year, Vietnam's exports starts to pick up. But if you are talking about interest rate cuts to protect local businesses, is very, very depending, because if your business has nothing to do with interest rates, then it is actually nothing much that can help for interest rate cuts to protect local businesses. But the interest rate cuts definitely is benefiting for some of the brokerage companies in Vietnam, because if you look at Vietnam's, their interest rate is very high, 5-7% easily. But when interest rate cuts happen, people in Vietnam typically will take up their deposit in the banks and starts to do investments. This is where recently some of the prominent brokerage companies in Vietnam has been doing very well, especially on if you look at the number of accounts openings for brokerage accounts, it has actually increasing recently in line with the interest rate cuts. Right.
All right. So thank you so much, Gabriel, for doing this segment for us from global to Vietnam. I guess that many of us here have gained adequate insights into Vietnam and what are the investment merits into this market. All right. So, ladies and gentlemen, you just heard from the Vice President of Intermediary Distribution, Mr. Gabriel Fong from UOB Asset Management. Thank you so much, Gabriel.